Today, we are going to demystify the fundraising process, break down the different steps involved in the fundraising process, and provide actionable insights that can help you raise your next round. The first step in your fundraising process is to determine how much money you need to raise. The amount of capital that you want to raise is determined by your growth plan. In most cases, companies are looking to raise sufficient capital to give themselves 18 to 24 months runway so that they can execute against their plan, reach meaningful inflection point, meaningful milestones, and give them the ability to raise more money in the future. How much you raise for that 18 to 24 month window is determined by a variety of factors. How big is your market opportunity? What is your current monthly burn? What is the stage of your business? How much the market is willing to bear depending on where you are in your startup's journey. How much dilution you and your current investors and your board are comfortable with. The amount of money you raise should be based on an achievable plan versus an aspirational plan. This plan should be one that you, your current investors, your board, and the new investors who are going to invest in the business can all get aligned on. You don't want to raise too much money because then you are giving up too much equity. At the same time, you don't want to raise too little money because now you don't have enough traction when you go to the market to raise more money. Once you know how much you want to raise, the second question then is when to start the fundraising process. This may sound cliche, but most founders, CEOs, investors you talk to say founders and CEOs are always fundraising. And as I said, while it may sound cliche, the reality is the folks, investors who are investing at an early stage of a company are very, very rarely the same investors who are going to help the company, fund the company through its entire life cycle. So once you have raised your round, you are going to the market, building new relationships so that when you are ready to raise additional capital, you have a network of people, a network of investors that you can reach out to. The best time to raise capital is when you don't need it, at least when you don't need it immediately, because that is what gives you leverage and time to find the best investment partner for your business. For example, if you have 9 months runway, meaning you have time to go to the market, meet multiple investors, find the best investor who is aligned with your vision for the business and work with them. But if you only have 3 months runway, you don't have a lot of choice. In those scenarios where you do have limited runway, oftentimes the current investors may bridge the company to their next round. If you end up raising a bridge round, make sure that you're not raising a bridge to another bridge. Make sure that you raise the right amount of capital that helps you reach the end goals that you wanted to reach with the bridge, and then go out to the market and raise more money. As you build momentum for your fundraising, get organized. Begin with the data room. A data room is a secure online place where your pitch deck and your business strategy documents and your financials are all organized in one central hub. For more information on what to include in a data room, click on the link in the video description. Fundraising is a sales process, and as a CEO, you need to be on top of it. Apply the same level of rigor that you apply on your salespeople when you are the CEO raising capital from investors. Once you have your prioritized list of investors that you want to raise money from, ask for introductions. It is always better to get a warm introduction to a potential investor than to do a cold outreach. After you have your first meeting with that investor, and if there is interest to engage further, get clarity on their sales process. There are some important questions that you can ask, like, do they lead around or do they follow on? Do they require a board seat? Are you and the investors aligned on the valuation range that you are looking for? Most investors will have you pitch to their partners. Get clarity on what is the timeline to get to a partner meeting. Answers to some of these questions can help you determine if you have the right fit with the investors that you are currently engaging with. While most funds have their own diligence process, you can also accelerate that process by combining efforts. For example, you can organize a single customer call where all investors can participate, or you can record a customer call. You can do a recording of your pro forma financial model and do a video walkthrough of the assumptions that are underlying behind the financial model. At the end of the day, you want to have all of the investors who are investing, who are looking at the opportunity to close in a similar timeline. If you want to close in 60 days, communicate that to all of your investors. Make yourselves available as needed to help them accelerate their diligence process and ensure that everyone is ready to close by that time frame. We hope this video has armed you with the knowledge and information needed to navigate the world of fundraising. Don't forget to like and share with fellow tech entrepreneurs. And do share your suggestions on topics you would like us to cover.